Since markets move in cycles, it can be helpful to understand these broad cycle movements. Very basically, during the expansion phase, we see growth, optimism, typically low rates, low unemployment, and high demand for goods and services. As the good times continue, a new peak is set, at which point people may become skeptical that the good times can go on indefinitely. A contraction or recession phase begins when people are becoming more conservative with their spending, causing businesses to downsize, putting downward pressure on the economic cycle. This downward pressure eventually hits its bottom or trough, a point where a new balance can be established and a new recovery or expansion begins. Historically, we have experienced a recession about every 6 years, and a recession typically lasts for just less than a year. The recession caused by the financial crisis lasted for about 19 months, while the recession caused by COVID lasted for only 2 months. As investors, that might sound like good news. 5 years of growth for every 1 year of contraction. And it is. Earlier in this chapter, we looked at how stocks and bonds have performed historically. And it's interesting to note that during different stages of the economic cycle, we can expect different behavior. During non-recessionary periods, or periods of growth, stocks or equities have the best performance. But this is really a time where everything thrives. Stocks, bonds, domestic or global, everything has done well during periods of growth. Since we expect more years of growth than years of contraction during a typical economic period, then this is definitely good news for investors. During recessions is a totally different story though. Since stocks do provide us with the most potential benefit for reward, they also do expose us to the most volatility. It's the risk we take as owners. Less volatile alternatives, like government bonds, tend to do much better as they provide safety and stability for investors. This chart shows the importance of a balanced and well-diversified portfolio. The right mixture of bonds within a portfolio can provide stability. One of the biggest issues with recessions is that we don't know when one will start, or even once we're in one, when it will finish. In hindsight, it's clear, but during the fact, it's impossible to know. Recessions typically aren't officially declared until many months after the fact, often leading to confusion. Another tricky thing is that stock markets aren't necessarily an accurate reflection of an economy at a specific time. Markets often act as a leading indicator, meaning that they often move in a direction before an economy is at the point to move in the same direction. Markets could begin to move down while the economy continues to boom, or begin to recover while unemployment continues to rise and it feels like the economy is still on the decline. When we look at our largest potential for growth, it actually comes out of recessionary periods. In the subsequent 6-month period following a recession, both US and global stocks significantly outperform their historical non-recessionary periods. This accelerated recovery then inspires the next wave of expansionary years. Recession recoveries often begin before a recession is officially ended. For example, in 2020, a recession began in February, ended in April the same year, but wasn't officially announced that the recession had ended until 15 months later. During that 15-month delay, the S&P 500 rose over 50%. When we compare how these different assets perform at the different stages we just covered, again, we see the patterns that support what we've discussed so far. The bonds have a more stable or consistent return across the different stages, with the total difference between the highest and the lowest return being 11.4%. And on average, regardless of the stage, we see a positive historical average return. But we can't say the same about stocks. The total difference between the highest and the lowest return is 58.8%, a difference of over 5 times that of bonds. And during recessions, much lower returns than bonds. But the major benefit is in the recovery and the higher returns during non-recessionary time. Remember, we expect good times much more than bad times. The accelerated growth we see after recessions is essential for our long-term success, because when our portfolio drops, we need a larger return than the drop to break even. Here's what I mean. For the sake of easy math, let's say we have $100 and our portfolio drops 50%, resulting in our $100 becoming $50. To go from $50 back to $100, We actually need a 100% return. We need to double our $50. A less dramatic version of this is if our portfolio drops 20%, from $100 to $80. We need a 25% return to get back to that $100 because we're down $20, which represents 25% of $80. When we experience a loss, because it's not a question of if, it's important to understand what has been normal. Investing is a rare thing where the best thing we can do often goes against what our gut instinct is telling us to do. By understanding how markets have behaved, we can have better insight into how they might behave in the future, which all begins with having a realistic expectation for how it all works.